My guest says that a dollar crunch is only weeks, not months away, and that the Fed is very close to issuing or sending out QE, quantitative easing again. Is he right? We'll talk about that and what is his reasoning. I'm really excited to introduce Rafi Farber. He's the Endgame Investor and writes the Endgame Investor newsletter on Substack. Really excited to introduce him to you here on our channel. And by the way, my name is Kai Hoffman. I'm the EdJR mining guy over on X and of course your host. And before I switch over to my guest, let me remind you, hit that like and subscribe button. It's a free way to support us, and we tremendously appreciate it. Rafi, it's a great pleasure to have you on the program. Thanks so much for joining us today.
Thanks for having me. Good to be first time on this show.
Yeah, really looking forward to catching up. Lots going on. And I just mentioned it in my intro. We have to maybe start with the looming dollar crunch and see where you're coming from here, Rafi. You're saying the dollar crunch is weeks, not months away, and that the Fed is just about to launch QE again. Run us a bit through your theory here.
Okay, so this is the tip of the iceberg of what I do. I'm more of a monetary philosopher explaining the nature of money, but we can start at the end and then maybe we'll go to the beginning. But the end is, look, we're on a giant pyramid. We're on a giant inverted pyramid, and there's a basement of money, of dollars, I'd say, not really money, of dollars that exchange hands every night. In the sewers, in the monetary sewers. It's really yucky and disgusting down there, full of corruption and craziness, and it smells bad and all that other stuff you find in sewers, rats and whatever. So what's happening is $2.8 trillion changed hands yesterday. And today I think it's going to be a new record because we're on June 30th, and record amounts of money change hands between banks on month ends. And this is a quarter end because I think this is the end of Q2, June 30th. So I'm betting we could see $2.9 trillion, maybe even $3 trillion. Now, the question is, where do those dollars come from? And the answer is they come from bank reserves. And why are they changing hands? Well, there's a whole bunch of bets that are being placed every single night in the using repo dollars, using these dollars that change hands between banks in order to place bets on Treasury futures and then sell the futures and buy the spot and whatever it is. It's like these stupid trades where banks get a cent or two per trade and then they multiply it 50, 60 times and they end up with millions of dollars free money every night doing this. So if we have $2.8, $2.93 trillion changing hands every day and we only have about $3.3 trillion in reserves, that's not a big buffer zone. You can't have more dollars changing hands than dollars that are available to change hands. So the minute that the debt ceiling is raised, that means the government or the Treasury is going to have to suck dollars out of those bank reserves and then spend them on a bunch of crap. And then there will be fewer bank reserves and fewer dollars to change hands. So all of those banks and hedge funds or whoever's doing it that are making those penny trades and multiplying it 50, 100 times over, if they run out of money in the repo market, those trades all have to close at the same time because they can't be funded, and then you have a crash. So once the Treasury, here's the crux of it, once the Treasury has to raise more money by adding to the debt and sucking bank reserves out of the system, there's not going to be enough dollars for the repo market to fund the basis trades that are happening every night, and the Fed is going to have to invent the difference. That's quantitative easing. There's no step down method of these huge trades. Once they build and build until they crash, which is what happened in 2019. And it's going to happen again shortly after the debt ceiling is raised, which is whenever this big, beautiful bill is passed, which has, pornographic connotations to it, thanks to Donald Trump. And it's going to be the end of, the end of something. It's going to be the beginning of the next quantitative easing round. And from there, I think the dollar is going to be destroyed shortly afterwards. Could I be wrong? Yeah, I could be wrong. There could be some kind of other rabbit that I haven't counted, but I don't see it.
Yeah, it's a grim theory, of course, but you're pointing in the right direction, I would assume here. There's a final squeeze looming, of course. Like, what's looking at a timeline? Like, how timely is it? The big beautiful bill supposed to be, signed by July 4th, which is later this week. How quickly do you think that scenario will unfold then?
Well, okay. I don't know exactly how quickly, but now we're splitting hairs. It could be 2 weeks, it could be 7 weeks, it could be, I don't know, 18 weeks. I don't know. Doesn't really matter. I mean, in the scheme of things, well, I can just tell you what the numbers are, and then you can make your own calculations. There's $300 billion left in the Treasury's bank account at the Fed. They could theoretically run that down to near zero and then start raising debt and then sucking out of bank reserves, or they could start sucking out of bank reserves immediately, which is, I think, what they will do. So, when they start taking money out of bank reserves and putting it in their bank account, once the money is in their bank account at the Federal Reserve, they have a checking account, like just like everybody has a checking account, but it's a special checking account. It's a checking account that is not counted as part of the money supply. Our checking account, my checking account at whatever bank, Bank of America, Wells Fargo, whatever, your checking account, right? Your bank can lend out those deposits because it's a fractional reserve. It's not even a fractional reserve bank anymore. It's a zero reserve bank because the reserve requirements are zero. So they can take your money and they can lend it out, and hopefully they didn't lend out everything. So when you want to take cash out of your account, then they just take it from somebody else, give it to you, and then it's all a big mess. But in their special checking account at the Federal Reserve, nobody can lend out their deposits. It's illegal. It's not part of the money supply. So once they suck the bank reserves out, nobody can use them. Not a single bank, nobody. So that becomes out of the money supply, outside of it, no more in the money supply. So it'll go back into the money supply, yes, when they spend it and give it to another bank to buy bombs or to buy welfare or whatever the hell they're doing, to pay social security checks. Who cares? So when but in the meantime, when the money is in their checking account and not at another bank, it can't be used. So if you look at the size of the Treasury's banking account, I think it went up to like $800 billion or even over $1 trillion in 2020, and it's at 300 billion. So if they raise it to, like, let's say 800 billion, 700 billion, that's 400 billion less reserves than there are now. And there's 3.3 trillion. So you take away 400 billion from that, you have 2.9 trillion in reserves. The supporting 2.9 trillion in repos. That's getting pretty close. That there's not enough. So that's why I say weeks. I don't know how many weeks. It doesn't matter. It's close.
No, fair enough. And I'm really trying to understand like the system behind it as well, because I think you were talking about monetization of debt here, and the Fed stepping in and just buying those treasuries. Is that the correct summary? You're just really simplifying it?
I don't know if it's monetization of debt. I'm just saying that there are some banks that don't have cash, and there are some banks like JP Morgan that have a whole bunch of cash. So let's say JP Morgan lends out its cash to these other banks so that their clients can borrow it through the repo market and then use it to fund Treasury futures trades. I'm not talking about monetizing any kind of debt, but in order for the dollar supply to be added to, how it's done is that the Fed buys treasuries, because they could buy anything. They could buy my chair. They could buy, I don't know, Harry Potter books. It doesn't matter. As long as those dollars are added to the system, it doesn't matter what they buy. And then the dollar becomes backed. The word we use is backed by whatever assets they buy. If they buy my table, if they buy my couch, then the dollars are backed by the value of my table and the value of my couch. It just so happens that when they buy treasuries, the dollar becomes backed by the asset that they're buying. Like, the dollar is a liability unit. A liability unit has an asset on the other side. The asset on the other side is mostly treasury debt. But treasury debt is the promise to pay those same liability units in a circle. And so you have an inflationary loop that, if it doesn't keep expanding, it collapses in on itself like a black hole. So you have, like, what we're, the situation we're in, I guess, astronomically, is a neutron star, where you have a star that's just dense enough to maintain its volume without collapsing into nothingness. But if it gets any more dense, it just collapses in on itself, and there's a black hole, and then it disappears, and you have an infinite density unit called singularity, and that's where we're headed. So what happens after the singularity? The dollar goes away, nobody uses it anymore, and we have to go back to what money actually is, which is gold and silver. Credit goes away. When credit goes away, money goes higher. The dollar is credit, it's not money.
No, absolutely. All else is credit, right? Gold is the only form of money. All else is credit, is the famous saying here.
It's not the only form of money. I'm just to be a little bit like, nitpicky on that. It's not the only form of money. There's no singular form of money. There's no one thing that's money and another thing that's not money. Money is a continuum. It just has to do with degrees of liquidity of whatever commodity. So the best money is the money that's the most liquid in a given economic system. If we're talking about a prison, it would be tins of mackerel or cigarettes, because that's the only thing that's allowed in there. But if we're talking about the entire planet, then the most liquid commodity between nations is gold. It just is. For whatever reason it is, it is.
No, true, absolutely. And maybe, Rafi, just to really simplify it for our viewers as well, how will they feel it? What will that look like for the average Joe out there?
It depends what you own. If you own dollar-denominated assets, let's say you own a company that has a lot of dollars but has no gold, right? Let's say a bank, because banks don't have gold. They can store gold for other people, but they don't have any gold of their own. So banks have no money. They have credit. So let's say you own stock in Wells Fargo or Bank of America. Just use the examples of banks that I came up with at the beginning of this interview, and they're in my brain now. So they have no. If these banks have no dollars and the value of credit goes to zero, if you have stock in Bank of America, it goes to zero. I mean, we've seen that before, banks' stocks going to zero. So if you have a big portfolio of stocks that are dollar denominated, they'll go close to zero. If you have deposits in your bank account, your checking account, they'll definitely be worthless. Either you won't be able to take them out, or you will be able to take them out and they won't be worth anything. Either way, it's the same thing. If you have a lot of money, meaning you have a lot of liquid commodities somewhere safe, not in a bank because they'll steal them, then all the purchasing power that is now in credit. What I mean by that is there's a certain amount of credit in the economy, right? And theoretically, all of that credit can buy all of the stuff in the economy. So if the value of that credit goes to zero, it's not like the stuff goes to zero. There's still stuff here. It's not like if we have a dollar collapse, every house blows up. It's it's not a nuclear war. It's a financial crisis. That just means the shifting of purchasing power. So purchasing power shifts from credit to money. Credit is the dollar. Money is gold. Right? The value of credit is based on money. That's where it comes from, that in the past, and all prices have to go into the past, or else there's no connection to the past, and therefore prices are meaningless. So for people who have money, it will look like a humongous shift of purchasing power into their pockets, and a humongous shift of purchasing power away from very powerful people, which on the one hand is good, on the one hand is extremely dangerous, because extremely powerful people, when they suddenly have no money, they get very upset, and then they start doing things that we don't like.
I was going to say, I was just going to ask you for some historical references as well. Like, have you seen something like that unfold before, like 2020 during the COVID crisis? Would you say are there some similarities that we can sort of draw conclusions from right now?
The COVID crisis wasn't much because the Fed could still add more liability units of dollars into the system, and people would still accept them. I guess the historical parallels would be any hyperinflationary moment in any economy where a central bank can print as much as it wants, but it doesn't make a difference anymore. So they just disband, and everything collapses. So Weimar, I think it was Hungary in the mid 1940s, Venezuela, Argentina. There's hyperinflations everywhere. The collapse of the Roman Empire in 300, 400 of the Common Era. That was the end of the West of the time. These things happen all the time. The failure rate of all currencies that are based on debt is 100%. So am I going to be crazy and say the dollar is going to be the first currency that survives, being debt based? No, I'm not. I'm a rationalist. I'm a realist. It's going to die.
How does the role of being the world reserve currency play into this theory? Like, does it just prolong the suffering, or does it actually maybe even save it? I'm curious what your thoughts are on that.
Okay, so the problem with the term world reserve currency is that people start getting confused, and they think that there's a category called world reserve currency, and it's like an empty box, and then each country gets to put their currency in it for a certain amount of time, and then everyone was like, okay, you get the box now, and then 200 years later somebody else gets the box. That's not how it is. It's not like a thing called world reserve currency that has to exist. Right? Just like there's no such thing as a single money. There's no one thing that's a money versus everything else that's not a money. It's not. It's just as money is not an artificial category that people just decide on and then vote on in a big stadium. It's a continuum. So world reserve currency just means the credit unit that most people use. The credit unit that most people use in the world is the dollar, and that's just an accident of history that the United States conquered all of the world after World War II and basically annexed the entire planet by giving dollar units to all the banks of the countries that it conquered, including the Soviet Union. Right, the Soviet Union started using dollars. And then because they didn't have really an economic system, they're communists, so their currency doesn't work. So they have to base their currency on a currency that's actually functional, which was based on gold back in the 1930s and 40s until 1971. And even now, it still is. It's just not convertible. So world reserve currency just means it happens to be through historical accident that America took over the world, and on that opportunity, once they won World War II, they went to all the financial centers of the world and said, look here, give us your gold. Even before World War II, they did this. They give us your gold. We'll store it here in New York so the Nazis don't, invade your country and take it. And then we'll give you dollars and you can use those. So everybody has dollars. And what does that enable? That enables like a huge inflationary pot, right? If you have more people taking your inflation through trade deficits, like everyone complains about the trade deficit. Trump complains about a trade deficit, but a trade deficit is the only thing that is keeping the dollar functional. Because what is a trade deficit? It's when America exports a whole bunch of dollars, which are backed by debt, and they get them out of the country, and in exchange for all those dollars, they get stuff, right? So you're importing more stuff and you're exporting crap. So that's great. If I had a printing press and I could just print out, pieces of paper and import a whole bunch of stuff into my house and have a trade deficit, I'd look really freaking rich. That'll be great. But then eventually people would call in my debt and then I wouldn't be able to pay them. So they'd take all my stuff from me because I couldn't pay. So that's what's going to happen. So the world reserve currency, it just increases the inflationary pot that America can skim off of. And that makes it a lot longer lasting, but it also makes the eventual, knocking on the door with the repo guy coming and saying, give me your stuff. It makes it all that much bigger in the end. So yeah, we just experienced the biggest several decades, let's say 50 years of humongous, insane prosperity for all Americans who basically didn't have to do anything in order to survive. And now once this is over, the trade deficits are going to reverse. They're going to become humongous trade surpluses, which are going to bring all the dollars back into America, yay, in exchange for all the stuff that they imported. And then everyone's going to be poor and they're going to have to figure out how to work again or die.
Drastic, but yeah, that's how that works usually. Rafi's like, how is that showing up in markets right now? Like what you're saying, your theories, like how much is priced in already when you look around? S&P 500 record high, gold at $3,300 an ounce, the DEUTSCHE dollar versus other currencies starting to drop down to 97 right now. So how is your theory showing up in markets right now?
Well, it's not yet, not entirely, but look, it is in a sense because the ratio of gold to the S&P 500 is lower than it was in 1971. So the real value of stocks is lower. Like if you took 10 ounces of gold and stuck it in your mattress in 1971, you'd have more purchasing power now than if you took the S&P 500 in 1971 and stuck it in your portfolio. You'd have more purchasing power with gold, which means the entire rise in the S&P 500 has been a chimera. It's been an illusion. It's not even real. But in 1980, what am I looking for in terms of price signals? In 1980, I think the S&P 500 was the high for the ratio of gold to S&P was, I think, 0.4 or 0.53, if I remember the number correctly. I don't remember exactly what it is. But whatever it was, it's like 78 times what it is now. So, but that only took that from 1971 to 1980, and really from like 1976 to 1980, in those 4 years, that's when that huge spike happened. So that's what I'm looking for, a rise of about 79 times in the value of gold versus the value of S&P, which means that everyone's purchasing power who has mainstream stocks will be cut into 80 pieces and they'll get to keep one, whereas everyone who has gold right now will suck in all that purchasing power, and that will be the end game. And silver even farther than that. I think it was silver that was set. That was 80 times. I think it was gold that was maybe 15 or 20. Sorry, I'm mixing up the metals. But in terms of the DXY, Truth is, I don't even follow it because the DXY, the dollar index, can't swing too far in either direction because it disturbs trade relationships. And once you disturb trade relationships too much, then exporters from some countries get upset and importers from other countries get upset, and they have all the political power because they control the economic spigots of the country, what's imported, what's exported. So when the DXY gets too weak, the Fed has to slam on the brakes, which they'll have to do. But if they do that, they cause a banking crisis. So we're getting into that territory where they have to pick if they want to maintain the dollar strength or they want the banks to survive. And once we hit a corner there, it's just going to explode.
Which way are you leaning? What do you think they're going to do? What's more important to them?
It doesn't really matter because once they get to the corner, whatever way they turn, the dollar is going to die. Either it dies because they give up, and then all banks collapse. All banks, not just some banks, all of them, because they're all connected. And then if that happens, you have a bunch of very unhappy bankers, and you don't want to deal with that, and very unhappy people who don't have any deposits anymore, and they don't have any money, and then you have to start riots in the big cities. Or they print, and then the same thing happens anyway because the dollar is worthless. Once you have that binary, you go either this way or that way, and either way, it's the same thing.
The result is the same. Right, absolutely.
Yes,
Rafi, I touched on it, but gold at 33, or we're close to 3,300 again, 32.86 as we speak here. What is priced in right now? Like, what's carrying the gold price, and what's the valuation of it?
What's priced in terms of gold? Why are people valuing it at 3,300?
Yeah.
I mean, I don't know. I don't know. Why is it 3,300 and not 3,500 or not 3,800? I don't know. I just know that it is money, and that it's not dollar bidding on gold. It's not that people have dollars and they're saying, well, how many dollars am I willing to offer for this amount of gold? And then they decide. It's gold. It's gold bids on the dollar. Gold is the money. It decides how many ounces of gold people want to give up in order to have some dollars that they might need for whatever purpose. But once gold is no longer exchangeable for dollars on the futures market or in a coin shop, then everything goes to hell. Then everything's over. There's no more dollar. There's no more banks. There's no more anything. Then what happens? Then you have to start over from the beginning with whatever real assets you have, and then start building an economy from there. And then from maybe a year or two later, you can restart a credit system, and hopefully this time it'll be an honest credit system. I'm not against credit, but I'm against dishonest credit. So you could rephrase the question and say, well, it's 3,300 now. What makes it go to 10,000? What makes it go to 20,000? I don't think 10,000 or 20,000. I don't think there's that much of a difference, because once it goes to 10, it'll go to 20, it'll go to 50, it'll go to 100, and then it'll just go to infinity. I mean, the final stages of these processes are very quick, and they always are. What causes that? I think the next round of QE, followed by the last round of QA started in 2019. It really took off. It's September 2019 it started, and it took off around COVID, which might have been an excuse to add more money. It might have been planned. It might not have been planned. It might have been something in the middle. I don't really know. But I think we're going to see something similar at the beginning of another round of QE, which I think will bring gold up to maybe 4,000, 5,000. And then banks will start getting in trouble, and they'll just start printing more and more and more, and then it'll just start going vertical, and that'll be the end of the story.
How do you think silver will behave in that regard? You touched on gold-silver ratio to a degree. What do you think silver will do then?
Silver is the public's money. Okay, so gold functions as money for banks. They don't have any in their vaults, except for maybe J.P. Morgan or something. But what they have is futures contracts, which are theoretically connected to the physical supply. So silver is not silver. Banks don't deal with silver. Like central banks don't have silver. It's too bulky. Silver is the people's money. So when people start to figure out that their dollars are losing purchasing power, they can't necessarily go to gold. So they go to silver, which means that the monetary demand for silver becomes infinite. It becomes for people need food, they need water, they need energy, but in order to acquire all those things, you need money, or else it can't be distributed. So famines, for example, are usually not due to a shortage of food. They're due to a shortage of money, because if you don't have money, you can't distribute the food. You can't tell where the demand is, so it just like rots on trains. If you read the book Mao's Great Famine, which is the greatest famine in the world from 1958 to 1962, it wasn't because of a lack of food. It was because the money didn't work, and and Mao's whole regime was controlling the entire, not because there was hyperinflation, but because monetary exchange was outlawed, and like everything was in the hands of the Communist Party of Mao to decide which food was going where, and they couldn't decide because they didn't know. So then all the food rotted. So that's what happens when you don't have money. So when the dollar no longer works, everybody goes to silver, and that reestablishes the historical monetary ratio of around 15-1 of gold to silver, which is where it was before 1873, when the silver price, when the dollar was a derivative of silver and gold by metallic standard. So we'll go back there. We'll go back to 15-1.
Just to maybe paraphrase a little bit here, Rafi, but what you're saying is that the industrial appliance, or everything that silver is being used for right now, doesn't really apply anymore. That's out of the door, because the other 50% is way more important, which is the monetary side. Is that true statement? Like, how are you factoring in the industrial side of it?
That's an oversimplification. The industrial side is important. It's not as important as the monetary side, but it's important because silver is a byproduct of mining. It's not really a primary product. Like the silver supply that we have is due to mostly, let's say, copper miners or lead miners or zinc miners. And then they mine a lot of zinc or a lot of copper, a lot of lead. Not that, maybe 5-10% silver. And so they sell the silver no matter what the price is. Since the price is so low, there's not enough silver being mined as a secondary product to satisfy all the industrial demand. So what will end up happening is that we're seeing silver inventories get lower and lower and lower as industrial demand takes up the silver inventories that are already above ground. And once those are zero, then you have a slingshot move. And what I think is going to happen is that's going to contribute to the rise in the price of silver. And the rise in the price of silver means, by definition, the destruction of the price of the dollar relative to silver. And since the dollar is a silver derivative, it was in 1873, therefore it still is now, not statutorily. I understand that it's not a statutory derivative of silver, but because the dollar was born out of silver, it still is a silver derivative. So if the price of silver is triggered to rise very quickly because the inventories that are being sucked out of these big safes or these big vaults, if they go to zero because of industrial demand, then that triggers the hyperinflation, the same hyperinflation that we're talking about from a monetary perspective, from an industrial perspective also. These are all different ways to look at what's happening, different angles at the same result here. So when that happens, it could be a catalyst, it could be a secondary cause, but it's going to happen, and then silver is going to go to 15-1. I think it's about 95-1 now. So silver should rise about 5 times faster than gold in dollar terms, and that's where most of the gains are going to be. And once it hits 15-1, buy whatever you can with your silver coins directly, like hand people silver coins and say, give me your house, give me your car, give me your business. That's how it's going to work for a little while until credit is reestablished. That's what we got to be prepared for.
No, I appreciate that, Ravi. What is one thing that would make you say, okay, maybe I was wrong here? Is there one thing that could sort of like throw your whole thesis upside down and say, okay, I was wrong here? Is there one thing?
Sure. If let's see, if the Fed decides to let the entire banking system collapse, then gold would go back to $35 an ounce. Silver would go back to 15 times less than that. But then you'd have the same thing, a 15-to-1 gold to silver ratio and all the purchasing power going into gold. I don't, I mean, I could be wrong on the timing. This could take another 10, 20 years. I don't think it will. I could be missing a lot of stuff. Maybe they're lying about the dollar supply. I don't see it lasting 10 to 20 years. Aside from any monetary reason, we're getting so close to nuclear war that, and people are acting so insane. Getting out of 2020 and 2021, we saw that people were willing to, end the lives of anyone who didn't make certain medical decisions, not in some cases murder them, in some cases just lock them in their homes forever because they were so afraid of them. So this is total insanity how people are behaving now. And now we're seeing AI. People are flirting with AI, having relationships with AI. People are already having trouble getting married and having kids and reproducing in the West, in the modern world. So if they were just wasting their time, they're already playing video games all day and not raising families. So what happens when they start, flirting with AI and then not raising any families? Well, we just stop reproducing and die. So that's what we're headed for. So we need some kind of reset that destroys everything, not all the technology, but goes back to some kind of level of technology where our basic will to survive is not disturbed. Look at Japan, look at South Korea. South Korea is dying. They're dying. Japan is dying. These people are not reproducing because of technology and the values that this technology has instilled in the society. So we can't last much longer on this inflationary system. It's going to have to go back to money, and a lot of people are going to have to rediscover what it's like to be human. And what it is to be human, that means you work hard, because we're not in the Garden of Eden. That's one of the first stories of the Bible. Like, you're going to have to work. Doesn't matter what technology you have, and if you don't, then so long to your society. So I see not so much longer to go here, and then we'll go back to something better. It's going to be hard, but it's going to be much better for our species and the planet.
Bit of a summary question for you, Rafi. Is like, if you were to find $1 million under your pillow tomorrow morning, how would you invest it?
Mm-hmm. I would put a lot of it into monetary metals. It's one of the companies that I work with. Monetary Metals takes your gold and silver and leases it to companies that use gold and silver so that they don't have to hedge their inventories with futures. So it saves them money. You get interest on gold and silver with gold and silver, in gold and silver terms. I don't, I wouldn't store it with me. I wouldn't hold cash. I don't want to hold too much gold. I want to hold a little bit of gold and silver with me, not too much. Just for emergency purposes. So I wouldn't hold any of it in my house. I wouldn't put any of it in a bank. I wouldn't put it in any stocks. Maybe I'd buy some mining stocks, maybe not. I mean, I already have some, and I think that's enough. So I just look to turn interest on it in real money terms until such a point that gold and silver is at a 15-to-1 ratio, and then I can go out and buy anything that I can see, houses, real estate, businesses, who knows, whatever.
No, fair enough. Rafi, really appreciate that. Where can we send our audience to follow more of your work?
Check out the Endgame Investor on Substack if you want to understand why gold is money and nothing else is as good of a money as gold. Bitcoin is not money. Bitcoin is a dollar derivative. It derives its value from dollars, not from gold. Everything else derives its value from gold. So check there for the basic monetary philosophy articles that'll help you understand everything, and so you'll be less distracted by all the craziness that's going on, and the moves in the markets won't disturb you as much because you understand the truth. And I talk about what's going on at the very bottom of the pyramid if you want to know what's going on in the plumbing system and why I think everything is happening in the next few weeks. I've explained it here, but there's more detail there. You can also check out my YouTube channel, Rafi Farber on YouTube, and I also have a Patreon, patreon.com/endgameinvestor, where I give biblical/religious lessons in money and economics, and that's where you can find me.
Fantastic. Awesome. Rafi, thank you so much for joining me. Really appreciate you coming on. We'll have to catch up soon and see how the theory played out over the summer and to where things are headed. Definitely interesting times. End of this week, we should see the big, beautiful bill signed. We'll see, and then we'll have some more facts to discuss. Fantastic. Rafi, thank you so much. Really appreciate it. Thanks so much for coming on, and everybody else. Thanks so much for tuning in to Soar Financially. Do you see the dollar, or do you see a looming dollar crunch as well? Please put that in the comments down below. How are you protecting yourself? We do want to hear from you. Let us know. What do you think of this interview as well? Give us a rating down below. Let us know. And if you haven't done so, there's a free way to support our channel. It's just by hitting that like and subscribe button. We tremendously appreciate it. Thank you so much, and take care out there.